This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us as we are reaching the end of September, very close to the end of September. We got a little bit more time there. First and foremost, thanks for joining me today as we talk about inventory and the cost of goods sold, also known as cost of sales. So today we're going to talk about inventory and cost of goods sold. And we're going to talk about how to value inventory, which is a very important concept to understand. Before we jump into today's lecture, just real quick, where we are in the classroom, where we're heading. We made it to week 6 already, so we are almost at that halfway mark for the course. Here in week 6, we got a couple of things going on for you. Related to inventory and cost of goods sold. We have our awesome, wonderful, fun hypothesis for this week. We're looking for 2 annotations and 2 responses, as you normally do. And the hypothesis is related to the valuation of inventory. So just as you've done before with other hypotheses, you'll select the part that is most interesting to you. You'll select the annotation button, and then you'll type out your annotation. Usually about a paragraph is what we're looking for. And then you'll click post, and then remember to go check back and respond to 2 of your classmates, and that'll get you full credit for a hypothesis. So very straightforward. Just wanted to point that out. And in addition to the hypothesis for this week, we have the Chapter 6 quiz related to inventory and cost of goods sold. So, without further ado, let's go ahead and jump into our conversation on inventory and cost of goods sold, also known as cost of sales. So, let me just adjust this real quick. Okay, great. So here's what we got going on. Today, we're going to talk about inventory and cost of goods sold as they relate to the retail business. We'll talk about how to value the inventory using specific identification, first in, first out, last in, first out, and weighted average methods. We'll also talk a little bit about lower cost of market, and I'll show you how to compute specific identification, first in, first out, last in, first out, and weighted average. You'll notice that we use a couple of different ways to compute inventory, and there's reasons for that, and I'm going to talk to you about those reasons in a very realistic way, because in business, most businesses look to limit their tax liability, and one of the ways of doing that is through inventory valuation methods. So we'll talk about that. So through today's conversation, I want you to really think about what happened last week when we talked about inventory briefly. Remember, we gave the example of Macy's, and we talked about the difference between the perpetual inventory system and the periodic inventory system. Today we're going to talk mostly about the perpetual inventory system, which we briefly touched on last week, and we'll also briefly discuss the concept of free on board and point of destination, or destination point. And remember, when we talked about things like free on board and shipping point and destination point, we talked about who's responsible for those goods while they're in transit. So let's briefly talk about that. Just kind of recap what we discussed last week. So when it comes to inventory, we look at who's responsible for that inventory. And a couple of ways that we examine that. The first one is called goods in transit, and that's the free on board shipping point and free on board destination, like we talked about last week. The second is called goods on consignment. Can anyone tell me, anyone on the call today, can you tell me, what do you think the word consignment means? What does that mean? On consignment. Have you heard that term before? Consignment? Anyone heard that term before? If you haven't, that's okay. Just kind of
It's
curious.
like consignment shop.
Yes, Joy, absolutely. It's just like a consignment shop. You nailed it. Denario, please. I saw your hand as well.
I wanted to answer, but I actually didn't really know.
That's okay.
But she got it.
Yeah, it's all good. It's fine to not know. And yeah, it's just like a consignment shop, exactly. So the way a consignment shop works is that people like you and I would bring our stuff that we want to sell to a consignment shop. We don't sell it to the consignment shop. The consignment shop sells it for us. Okay, so think of the consignment shop like a little market. Okay, like a farmer's market, except it's other goods like clothing and durable goods. So with a consignment shop, the way it works is an individual like you and I want to sell our goods. We bring it to the consignment shop. The consignment shop sells it for us to a customer. And then later, the consignment shop will pay us for the goods that they sold on our behalf. So that's how a consignment shop works. It's kind of like an intermediary or like a marketplace, yeah. Of course, the consignment shop's going to take a small percentage because they got to get paid so they can pay the rent on their place. But yeah, that's exactly right. Goods on consignment. Okay. Now, when it comes to who's responsible for the goods when it's on consignment, ultimately the seller, the person selling the inventory through the consignment shop, is responsible for that inventory until it's sold. Okay, so if, for example, God forbid, the consignment shop burns to the ground, the seller is responsible for the loss of the inventory, of their inventory, not the consignment shop, you see. So the consignment shop is just an intermediary. So that's goods on consignment. And the last part of inventory, special things, is called goods damaged or obsolete. We briefly touched on this last week. Remember when we talked about returns? And I got upset because I don't like when customers return stuff to me. So sometimes it happens. And sometimes the reason why the customer returns goods is because they're damaged. All right. So damaged goods typically infers that the goods were damaged in transit when they were getting to the customer or to the store or whatever, right? So that's damaged goods. And the other one's called obsolete. Does anyone know what obsolete means? Have you heard this term before? Who can tell me on the call? Who can tell me what is obsolete? What does it mean to have an obsolete good?
Missing.
Not quite, Joy. Not quite missing. Think of what happens when you have the product.
Inoperable.
Not quite. It still operates, but think about what happens like when it sits on the shelf for a long time. Go ahead, tell me.
So it's
Noreen.
Outdated.
Outdated. You nailed it. Yes, outdated. So it's outdated. Exactly right. So think about I don't know what iPhone just came out. We'll say it's 14 or 16 or God knows what number they're up to these days. Probably 20. So anyway, iPhone whatever's comes out a few days ago. Okay, a few days ago, latest and greatest iPhone comes out. What happens to the model before that one? Okay, so if 14 just came out, what happened to 13? Good old lucky number 13.
Discounted.
It gets discounted. Yeah, why? Because it's
A lesser
Obsolete.
version.
obsolete.
Obsolete. Yeah.
Yeah, exactly. Yeah. So the reason why it's obsolete is simply, as you said, because it's out of date. It's no longer relevant. It's, the latest and greatest thing replaces the obsolete good, you see? And so that's what obsolete means. Yeah. Very good. Cool. So just like we talked about last week, free on board shipping point means that the goods are included in the buyer's inventory when they are shipped. In other words, free on board shipping point means that the buyer is responsible for the goods while they're in transit. And free on board destination means that this seller is responsible for the goods while they're in transit. Okay, so that also tells us when those goods go into the respective inventory. So if I am purchasing, let's say I'm Macy's, okay, Macy's. I got two different kinds of vendors. All right, I got this one distributor A, and I got distributor B. Distributor A is free on board shipping point. Okay, what that means is Macy's, I need to include the inventory in my inventory at the time it was shipped to the store. Okay, that's free on board shipping point. Free on board destination, that's my distributor B. Distributor B says free on board destination. That means I don't put it into my Macy's inventory until after I've received it. Okay, so that's the way to think about this. And as we mentioned, goods on consignment, the consignor is the owner of the goods. So if I want to sell my stuff through a consignment shop, I'm the consignor. It's my stuff. I own the stuff. I'm giving it to the consignee, which is the consignment shop. Okay, so consignor, owner of the goods. Consignee, the consignment shop. They sell the goods on behalf of the owner. Okay, merchandise is included in the inventory of the consignor. It's my inventory. The consignee never reports consigned goods in inventory. So if you go to a consignment shop and you ask them, what do you have in your inventory? They're going to say nothing because it's a consignment shop. They don't own the inventory. The consignors, the individual owners that sell through the consignment shop, do. You see? And then, as we just discussed, damaged or obsolete goods are not reported in inventory if they cannot be sold. Damaged goods are damaged goods. It might be a little scratch and dent. Hey, no problem. It still works. Not a big deal. We'll still include it in our inventory. We'll probably sell it at a discount, because it's got a scratch and dent. Okay? Obsolete goods, I might still be able to sell them. Apple's still selling the iPhone 13. It's obsolete because it was replaced by the iPhone 14, but they're still selling it. Okay, so they'll sell it at a discount. Now, in some cases, it don't work that way. What I mean by that is that if it's damaged beyond repair, okay, that the television that I was going to sell that's in my inventory, the screen is smashed, okay? I can't sell that, right? So it's damaged. It's damaged beyond repair. So in that case, I have to take it out of my inventory because I can't sell that, you know? Or let's say the iPhone 3 is sitting in the back stock room at Apple, and some employee found it sitting back there, and they're like, "Man, this thing belongs in a museum, not in the store." So they're not going to sell this. They're not going to sell that. It's obsolete, very obsolete. So in that case, they'll take it out of their inventory. Yeah. So just ways to think about that. So damaged or obsolete goods are goods that, if they can be sold, they'll remain in inventory at what we call their net realizable value, which means the sale price minus the selling cost. Okay, sales price minus the selling cost is the net realizable value. Sale price minus the selling cost. Net realizable value. And any loss is recorded when a damaged or obsolete item occurs. I had mentioned, and I think it was last week, I want to say it was last week, I'd mentioned that the cost of goods or the cost of inventory, it's not just the purchase price. Okay, it's not just the purchase price from the vendor or from the distributor. Okay, it's not just the cost of acquiring that good from the distributor or vendor. It's usually that original cost plus a bunch of other stuff. And that other stuff includes things like shipping, storage, insurance, and import tax or import duties. Okay, so the way we calculate the cost of inventory is we take the invoice cost, which is the cost of the product, minus any discounts that we may have received from our vendors, because we like to pay them early, right? The credit terms, 210 net 30 or whatever, plus any other costs like shipping, storage, insurance, and import duties. Import duties, the word duties means tax. Okay? So shipping, the cost of getting the product to you, the seller, okay? Storage, you got to keep your inventory somewhere. And sometimes there's a cost associated with that, right? Especially if you're, renting a storage unit or something. Insurance, you had to insure, cost of insurance, the product from when it was shipped from your distributor to get it to you. Okay, cost of insurance. Sometimes that also includes the cost of insurance on the facility that the inventory is stored in. And any import tax that you had to pay to get the goods to you. So we call those other costs, yeah? So invoice cost of the good, minus any discounts you may have received, plus other costs equals the total cost of inventory. All right? In business, it is so important to prevent loss. So important to prevent loss. And one of the ways that we do that is by controlling our inventory and taking a physical count of the inventory at least once a year. So if you've ever gone to a shopping mall or a big box retailer, you may have been there at a time where you saw all these little tickets, okay, attached to the shelf. And you're like, what's going on? Is everything on sale? No, not everything's on sale. They're doing inventory. Okay, they're doing a physical count. They do it once a year at least. Okay, I always recommend you do it twice a year, but that's just me. Right? So So for example, you go into, we'll say Walmart or to Macy's or some large retailer. You go in, and sometimes you might go in on a day toward the end of the year or end of half a year or whatever, let's say end of June, and you're going to see a bunch of people in there, counting and putting tags with the amount, barcode with the quantity on the shelf. Okay, they're taking inventory. And so that physical count, the idea here is that we're comparing that to what we have in our accounting system, okay, in our register system, machine, whatever, our accounting system. We're comparing what we have in our accounting system to what we actually have on our shelves. If there's a difference, we need to make an adjustment, do an adjusting entry. And it's usually a loss if it's not there. Why a loss? And what happened to it? We don't know. It could have been stolen. It could have been used as a display. It could have been, lost. Okay? So things happen. But we have to account for those things that happen. So a good internal control system over the inventory count includes things like pre-numbered inventory tickets. So I got each ticket has a unique number, and I attach that number to the shelf, and I write down the quantity on the shelf. The counters do not have inventory responsibility. In other words, the people counting the inventory, those should not be salespeople, or they should not be store associates. Typically, a business will bring in an outside company that does inventory for them. One of the largest companies in America that does inventory for other companies is called Regis, Regis. They're one of the largest inventory companies in America. They come in and they do physical counts for companies like Walmart or Macy's or big box retailers like Best Buy or whatever. The counters confirm the number of units on the shelf, the existence. Yes, they're there. Here's the number. And what's the condition? Is it in good condition or is it damaged? The fourth thing they do is there's a second count taken by a different person. So the first person goes down the aisle, counting all the stuff on the shelf, okay, taking inventory, everything on the shelf. A second person comes in behind them to verify. And the fifth and final step of the process is a manager confirms all items are accounted for only once. So the manager will then go through and verify, yes, this is correct. And then they'll match it to what's in the inventory system. But that's the typical process of a control process for taking inventory. There are 4 primary methods for valuing inventory. When I say the word value, I mean assigning cost to that inventory. Okay, there's 4 primary methods. The first is called specific identification. Specific identification is a very unique method for assigning cost to inventory. This type of thing, specific identification, is reserved for the type of products that have a serial number associated with it, and there's not a whole lot of them. An example of a company that would use specific identification would be a car dealership. A car dealership will use specific identification because each car has a unique identifying number, also known as a VIN number, vehicle identification number. The vehicle identification number is inherently specific identification. And therefore, a business like a car dealership will use specific identification. Essentially, what that means is that each individual unit has its own cost. Okay. The next three we're going to go through an example with, and I'm going to take my time with it because these next three can be somewhat confusing for some students. So I'm going to walk you through it, okay? The second one is called first in, first out, or FIFO, first in, first out, FIFO. What first in, first out means is that as the inventory is coming into the store, I'm going to sell that first inventory we received. Okay, as inventory comes into the store, I'm going to sell that first inventory that we received. I want you to think about a grocery store using first in, first out. Why do you think, for those of you on the call, why do you think a grocery store might use first in, first out? It's the first that they got in, and they want to get rid of it first. Denario.
Because they want to get rid of perishables early. That way they don't go bad.
100% correct. You nailed it. So the idea here is that the grocery store doesn't want stuff to go bad on the shelf. So if I get rid of it as soon as it comes in, it's still fresh. Okay, I'm not going to lose that inventory because it went bad. You see? So that's why a grocery store would use first in, first out. That's an excellent example, and very good, Denaro. Thank you. The next one is called last in, first out. Last in, first out, or LIFO. The reason why a company might use last in, first out is because their goods might not be perishable. Okay? They don't care when they sell it. So the last one I got in, I'm going to get rid of it first. Okay? Example of a company that might use last in, first out would be a company like Best Buy that sells electronics. Okay? Or maybe Walmart that mostly sells durable goods. Or Macy's, they probably use last in, first out. Okay? It's just a process. Last in, first out. The last method we call weighted average. Weighted average. And just as the name implies, we add up all of our inventory purchases and we take the average cost. Okay, so that way everything is distributed evenly across the inventory. Yeah, weighted average. So I'm going to go through the example, and here is the example. Now here we have, we'll say, three different companies using three different methods, or we have one. Let's take that. Let me take that back. We have one company that is looking to use one of these three methods, and they're not too sure which one is best for them. All right? Because in business, and this is very true, that a business can select one of these three or four methods to value their inventory. And I'm going to explain why here in a second. Oftentimes, a business will try to calculate these three methods to figure out which is the best for them. So first we have first in, first out. Again, the idea here is that the first purchase I made is going to be the first one out. All right. So here we have an example. On May 1st, the company purchased $45 worth of inventory for this particular product. On May 3rd, the company purchased an additional $65 worth of inventory from their vendor for this particular product. And on May 6th, the store purchased an additional $70 of inventory from their vendor for this particular product. It's the same product. It's the same thing. Let's say it's a pair of shoes, okay? Pair of shoes. Actually, that's a great example. This is a pair of shoes, all right? Same pair of shoes, you know, the company purchased for $45 on May 1, then again, purchased another pair of shoes from the vendor, $65, and then again, May 6th, purchased another pair of shoes from the vendors for $70. They're all the same exact pair. Now, you might be wondering, well, Dr. B, why is the price different for each purchase? You know, think about things like inflation, the cost of delivery, the cost of insurance. So you can buy the same exact product at 3 different times in the same month. You're going to pay different prices each time. Yeah, that absolutely. That's totally normal in business, right? So, first in, first out. The idea here is that I'm going to sell the first purchase that our company made. I'm going to sell it first, right? First in, first out. So here we go. I sell each pair of shoes for $100. Okay, $100 pair of shoes. All right. I sell the first in, first out. Okay. The cost of that first pair of shoes that our company purchased was $45. So my sale price of $100 minus the cost of goods sold, $45, means that I will have a gross profit of $55. Okay? At the end of the month, I still have 2 additional pairs of shoes left. So therefore, my remaining balance on my balance sheet for inventory is $135. How'd you get $135? We took our remaining 2 purchases that we had left, okay? I didn't sell the one from May 3rd. I didn't sell the one from May 6th. So 65 plus 70 is 135. So that's first in, first out. Does that make sense to everyone? Pretty straightforward, I hope. Good so far, yeah? Okay.
Yes.
Awesome. Thank you, Joy. All right. The next one is called last in, first out. In this case, I'm going to sell the last pair of shoes that our company purchased first. Okay? So, I made the same 3 purchases. Nothing changed here. All the dates and the prices are the costs are the same. I'm going to sell the last one first. The last purchase I made, the pair of shoes, was $70. So I need to sell that one first. Last in, first out. The sale price of the pair of shoes is $100. The cost of goods sold is $70 because the last purchase I made was for $70. That gives me a gross profit of $30. 100 minus 70 is 30. That means my remaining inventory balance at the end of the month is $110. How 110? 65 from May 3 plus 45 from May 1 gives me 110. So that's last in, first out. Okay. The last one of this is called weighted average. Again, the idea of the word average means average. We distribute the weight across all the purchases evenly. The cost is distributed evenly. Okay? So the way weighted average works is I add up all of my purchases, the cost of all my purchases, and I divide by the number of purchases. You see? In this case, I made 3 purchases. $45 May 1, $65 May 3, $70 May 6. I add them all up and I get 180. I divide by the 3 purchases. That gives me a weighted average of 60. I sold a pair of shoes. The cost of the pair of shoes using weighted average is 60. So my sale price, $100, minus cost of goods sold 60 gives me gross profit of 40. That means my remaining inventory balance on my balance sheet is 120. How 120? 60 times 2. You see how we got there, right? Now, for those of you on the call, or you business majors, okay? Tell me, business majors, out of these three options, which one do you think the company should choose? Which one is best for the company and why? Who can tell me on the call which of these three options is best for the company and why? What do you think? Don't shout at once. What do you think? Which of these three options is best for the company and why?
Weighted average. I
Weighted
think.
average scenario. Okay, so explain why.
So the reason why is because, I mean, obviously it depends on whatever company that you're trying to have this for, but just
Right.
generally, weighted average is very universal, regardless of what kind of goods that you're using. And while it does take more work than first in, first out, or last in, first out, because you have to do some extra accounting work, it's just so generalized and stable that I think most companies would go with that third option.
That's very logical. I like that explanation. Very good. Joy, I saw you unmute. What do you think, Joy?
I was gonna say either last in, first out or weighted average. By this example, of course, last in, first out is the best because you end up only having to still sell $110 worth of product. So that would be the best. But I think like I agree with Denario, depending on the company, average price is gonna get you close, seems like on either
Yeah,
end, but you would do best with LIFO.
that's a awesome argument, Joy. Very well done. Very well done. You both made very good arguments for this case. So since both of you made the argument for this case, I would like to make the argument for first and first out. Okay, so just to keep the conversation good. So why would I choose first in, first out? You might ask. Well, it gives me a gross profit of 55. All right, out of the three, first in, first out has the best profit. Would you agree? I think yes, right? So based off of profit, first in, first out looks great. However, the inventory on first in, first out, as Joy alluded to, I would have to sell 135 worth. Okay, so that makes it a little bit more challenging. So the point to this discussion is that there's pros and cons for each one. Now, in real life, what would the business choose? I would say I would go with Joy on this one. And I think last in, first out would be the best choice. And the reason why I personally believe this, and why I think I know this, because I talk to a lot of business owners that sell inventory. With last in, first out, you'll notice that they have the lowest gross profit and the lowest remaining inventory. You might be wondering, how can that be a good thing, right? The reason why it's a good thing is because they got to pay taxes. And when the business pays taxes on their gross profit or their inventory balance in some states, less than first out's the most attractive. So I'm not going to have to pay a whole lot of taxes on $30 worth of gross profit, not as much as I would on 40 or 55. And also with the lowest inventory balance, my tax rate's not going to be that high on that out of the three options. So I would agree with Joy. I think last in, first out is probably the best option in this scenario. I also agree with Denario's logic an argument behind weighted average because I think that that's a good option as well. So very good discussion. Thank you for joining in on that. I think that was fun.
Sorry, I had a question.
Yeah,
If this
Tanika.
was a restaurant, would it not be a different scenario? Because with restaurants, they use FIFO, they use first in, first out because the food could spoil if you let it do
That's
either
correct.
of the other scenarios.
Yeah, absolutely. You're right, Tanika. So as Denario alluded to earlier, it depends on the business, right? So to answer your question, Tanika, yeah, I'm pretty positive that a restaurant business, who I also do some consulting with, I know that that particular restaurant uses first in, first out, and also to your point, Tanika, I would also say that a grocery store would also use first in, first out for that reason, because their inventory will spoil if you leave it for too long. Yeah. So yes, excellent point, Tanika. It really depends on the type of business, but for we'll say tax reasons, last in, first out's the best choice. But yeah, excellent discussion. Thank you for saying that. Very cool. So, just as we talked about last week, when we compute inventory balances, we look at, how do we add this up? How do we know what the remaining balance is? We take the beginning inventory plus our purchases equals merchandise available for sale. Or you can do ending inventory plus cost of goods sold will also give you merchandise available for sale. You remember that slide from last week. Same one. Okay, so that was a fun exercise. I really enjoyed that. So in thinking about our perpetual inventory system, using the barcode method, etc., and now that we know how to compute it, we can look at specific identification, first in, first out, last in, first out, and weighted average, using that same methodology we just used in that earlier example. So in thinking about the perpetual inventory system, we know that it continuously updates, and that means that our inventory on our balance sheet is going to continuously update, and our cost of goods sold on our income statement will also continuously update on a relatively automatic basis. So in this case, the physical flow does not need to follow the exact cost flow, since it's perpetual. First, let's start with, and this is looking at using the perpetual inventory system. We're going to examine all four methods, okay, using this data. So here we have a set of data for a company that sells bicycles, mountain bicycles, and we got their data from last month, the month of August, okay? So here's their data. They started the month of August with 10 mountain bikes in inventory, and the cost of acquisition for those mountain bikes was $91 each. That gives them a beginning inventory balance of $910. Okay? On August 3rd, they purchased an additional 15 mountain bikes from their vendor or distributor for a total of $106 each. That means that we purchased an additional $1,590 worth of mountain bikes. 106 times 15. Now we take our original 10 plus our new 15 to give us a August 3rd balance of 25 mountain bikes in inventory. On August 14th, we had an awesome sale. We had a bunch of people come in on August 14th. They purchased 20 mountain bikes in total, and we sold each mountain bike for $130 a piece. On August 14th, at the end of the day, that means we only have 5 mountain bikes remaining in inventory. Then on August 17th, we purchased an additional 20 mountain bikes from our distributor for $115 each, for a total of $2,300. That brought our inventory count up to 25. 5 from August 14 plus the 20 we purchased. On August 28th, we purchased an additional 10 mountain bikes for $119 each. That's $1,190. That brought our balance of mountain bikes to 35. The previous 25 plus the new 10. Then on August 30th, we had a sales rush. A lot of people came in. They bought mountain bikes that day. We sold 23 mountain bikes at $150 each. That means I had a remaining balance of 12 at the end of August. At the very bottom, you'll notice of this graph, we have the total purchases of mountain bikes we made throughout the month, total of 55. Well, it's the purchases plus beginning inventory. We also see our total inventory value throughout the month, $5,990. We sold a total of 43 mountain bikes in the month of August, and at the end of August, we have 12 bikes left. So now that we know what the data is, let's take a look at the 4 inventory cost methods to kind of get a better understanding of how it all works side by side. The first one we're looking at is called specific identification. Earlier, I had mentioned that with larger pieces of inventory like an automobile, there's typically a vehicle identification number or VIN or a serial number associated with the product. Right? In the case of bicycles, you can decide to sell using specific identification for your inventory method because each bicycle typically has a serial number associated with it. So in this case, using specific identification is very straightforward. There's nothing special here, okay? So we have all of our purchases, we have all of our sales, and then we have our inventory balances. Real simple, real straightforward. Beginning balance, August 1, purchases August 3rd, purchases August 17, sales, August 28, more purchases. Then we made some more sales, August 30. And we can see, our totals. Very straightforward. That's just specific identification, nothing fancy here. Very easy. Then we introduce first in, first out. That is where we sell the first one first, right? We got it into the store, we're going to sell that one first. First in, first out. With first in, first out, typically what this means is that the most recent costs are going to represent our ending inventory. Our oldest costs represent cost of goods sold. Why? Because our oldest costs, which is our first purchases, we're going to sell those first. So as we sell them, it moves from inventory to cost of goods sold. That's what that means. So let's look at that same data set using first in, first out. I started the month of August with 10 bicycles at $91 a piece. I purchased an additional 15 on August 3 at $106. That brings my total inventory up to 25 bikes, right? At a value of $2,500. On August 14th, I made some sales. Now remember, first in, first out. That means I'm going to sell my beginning inventory first. Why? Because I had that first. Sitting in my store first. Got to get rid of it first. Okay, so first thing I'm going to do is sell those first 10 bicycles that cost me $91 a piece. And then I'll sell the rest of what I have left in inventory. You see? So on August 14th, remember, I sold 20 bicycles. I'm going to get rid of that first batch first, 10 at 91. Okay, I'm going to get rid of that first. Then I'm going to get rid of another 10 out of that 15 purchase from August 3. So I sold 10 at 106 was the cost. So my total cost of goods sold for August 14th was $1,970. I update my balance, you see. My balance is remaining is 5 at 106. So I only have 5 left from that August 3rd purchase. August 17th, I purchased an additional 20 bicycles at 115. I add that to my inventory. I update my inventory cost to $2,830. August 28th, purchased another 10 at 119. I add that to my inventory balance, bringing it up to $4,020. Then on August 30, I sold, I forgot how many it was. I think it was like 25 bicycles, right? So, or not quite, it's 20 something, I forget. So what do? I got to sell the first ones first. I had the 5 remaining from August 14. I'm going to sell them first. 5 at 106 is 530. Okay, get rid of that 530. Then I'm going to sell an additional 18. Additional 18 came from my August 17th purchases. Okay, so 18 at 115 each is 2,070. So my total cost of goods sold on August 30 is 2,600. Then I update my remaining balance. My remaining balance comes from, I think I had, actually that should say 2, not 5. 2 at 115 from August 17. The other number is wrong too. And 10 at 119. So this last part of the slide is incorrect. So this 5 should actually be 2 at 115. And yeah, 2 at 115. And this 7 should actually be 10 at 119. But you see the point. You see the point we're getting to. The next method, as you know, is last in, first out. This means that my most recent costs will be representative of my cost of goods sold. Why? Because the last ones I purchased will be the first ones I will sell. The oldest costs, the ones I made, the purchases I made before that, will represent my ending inventory. Here we have the same exact data. Let's take a look. Beginning balance 10 at 91, August 3, purchase 15 at 106. Add to the inventory. August 14, we made some sales. Okay, we sold 20 bicycles on August 14, as you know. But because we sell last in, first out in this method, we're going to sell that 15 first. Last in, first out. So I'm going to sell 15 at 106 for 1,590. And then I'll sell the additional 5 from my beginning inventory balance. 5 at 91 gives me 455 for a total of $2,045 of cost of goods sold for August 14th. That means I have a remaining inventory balance of 5 at 91. August 17th made more purchases, 20 at 115. And then August 28th, I purchased 10 more bikes, 10 at 119. Then August 30 rolls around. August 30, remember, I sold 23 bicycles. 23 bicycles August 30 I sold. So the first I'm going to sell is the 10 at 119 from August 28th. Remember, last in, first out. So 10 at 119 is 1,190 plus 13 from the prior purchase, which was 20 at 115. So I sold 13 at 115, 1,495. Give me a total cost of goods sold August 30 of 2,685. And then my balance is updated, you see. I still got the original 5 from the beginning balance, and I got 7 left from the 115 on August 17th there. So that's last in, first out. Any questions? First in, first out, or last in, first out? Good. Okay. Then we got Denario's favorite one, weighted average. So for weighted average, as the name implies, we take all of our purchases and divide them by the number of purchases. You'll notice that with all that data we have to continuously update the average, right? Why? Because the more purchases that we have coming in, the more we have to update it. See what I'm saying? So let me show you what that looks like. So here we have beginning balance, 10 at 91. August 3, I purchased an additional 15 bikes at 106. If I add up my 10 at 91 and my 15 at 106, I get 2,500. So what I'm going to do here is I'm going to take that 2,500 and divide by the 25 bicycles I have in inventory after this purchase was made. That gives me an average of $100 per bicycle. You see how that works? So then time goes on. I make more purchases. I make more purchases on August, I sell some first. August 14, I sell 20 bicycles at $100 each was our cost, okay? Then I made more purchases on August 17. I got 5 remaining at $100 each, plus the 20 bikes at 115, gives me a new inventory balance of 2,800. That's a new 25 bicycles I have in inventory. 2,800 divided by 25 units is $112 per bicycle. On August 28th, I purchased an additional 10 bicycles at 119. I do that same process again. I add it in to the existing 25, so 10 at 119. I get 3,990 divided by my new inventory of 35 bicycles, gives me $114 per bicycle. See how that works? And then August 30, as you know, I made some sales. I sold 23 bicycles that day, and the average cost was $114 per bike. You see? So that gives me cost of goods sold total of $4,622 for weighted average. So you can see, the concept of weighted average. We update the average based off of the purchases and sales we make as the time goes on. Because remember, it's weighted. So when it's a weighted average, it means we're taking everything into consideration as time moves forward. So that average is continuously updating. To Denario's earlier point, it's a pain to calculate, but it is very effective. As I mentioned, there's a reason why a business selects one of these 3, and it's usually for taxes, right? So, in comparing the 3, we know that first in, first out, depending on what it is that we're selling, Tanika, we might be selling some perishable goods. We're going to use that one. And I think inventory is approximate of the current costs for first in, first out. That's oftentimes why you see a restaurant update their menu pricing as well on a regular basis. That's because they're probably using first in, first out for their inventory cost. Last in, first out, this approximates the current cost on the income statement. It's cost of goods sold. And the weighted average smooths out any price changes. So those are the benefits of using each one, right? So if we look at a side-by-side comparison of all four methods using our example of the August data that we have from the bike shop, we can see the difference in cost of goods sold. So based off of this information, we got to figure out which one's the best one to use for the bike shop. Okay, so sales minus cost of goods sold equals gross profit. If I'm looking at this, I might say, and again, you can make an argument for each one. I might say, oh, I really like first in, first out. Why? Because it has the highest gross profit. As an investor in the company, I like seeing profit. Okay, good argument. However, when it comes to taxes, which one's the best one? I would have to say it's last in, first out. Why last in, first out? Because it has the lowest gross profit, which means for tax reasons, I'm going to pay the lowest amount of tax on my profit. It also has the lowest inventory balance. And again, for tax reasons, the lower amount, the less taxes we have to pay. You see how that works? So in business, we like to look at all four methods just to kind of understand which one is going to be most effective for us for reporting reasons. So even if the restaurant is, we'll say, a restaurant, if the business is a restaurant, they probably use first in, first out. Although they probably take a bigger hit when it comes to taxes when they report it that way. See how that works? So for IRS tax reporting reasons, majority of businesses use last in, first out, right? Because they don't want to pay as much. And I can't say I blame them. One of the last parts I wanted to talk to you about today related to this concept of inventory cost is what we call the lower or of cost or market. This is a very simple concept. It means that we're going to report our inventory either at market value or at its cost, whichever is lowest. Lower of cost or market. That's what that means. I'm going to report the inventory at either its market value or its cost, whichever is lowest. Okay, lower cost. The market value is also known as replacement cost. Market value is also known as replacement cost, not sales price, replacement cost. And that's the idea behind it. Here's an example of this. I have two different types of vehicles that we're manufacturing here. I got units times cost. It gives me the total cost. Units times cost gives me total cost. The market price times number of units gives me total market. So I'm going to take whichever is lowest, either the market price or the total cost. For the Roadster, the first vehicle here, it's the market price. It's going to be lowest over the cost. And in the second example, the cost is lower than the market price. So just give you an idea. That's lower cost or market. Which one is lowest is the one that we'll record. And it's just a matter of taking units times cost or units times market to get total cost or total market. Yep. Very simple calculation. Okay, and then with inventory, as you know, sometimes we make mistakes in accounting. I mean, we're not perfect, you know this. And so we need to adjust for those mistakes. We make errors in inventory. Yeah, absolutely. Sometimes we we miss a shelf. We didn't count that over there. Oh, I forgot about the inventory that's sitting in the supply room. Oh, I forgot about the inventory that's sitting in that off-site storage unit. Okay, it happens, right? So we make adjustments. If the inventory is understated, that means our cost of goods sold is going to be overstated. That also means that our net income is understated. So then we make the adjustment in year 2, and that'll understate the cost of goods sold and overstate our net income. It balances out. If the ending inventory is overstated, that means cost of goods sold is understated. That means our net income is overstated. In year 2, we make the adjustment. It will overstate cost of goods sold, which means it'll understate net income. It balances out. Sometimes it balances out over time, is what we're saying. Okay? It's when we have errors. This just summarizes the effect on the balance sheet. If the ending inventory is understated, that means our total assets are understated. That also means our equity is understated. The opposite is true if the inventory is overstated. Yeah, very straightforward. As I mentioned, one of the most important things in business is to understand the financial health of the company. And one of the easiest ways to do that is by calculating a couple of ratios. When it comes to inventory, one of the most important ones is called the inventory turnover ratio. This tells us how many times a company turns over its inventory during a month or an accounting period. It's an indicator of how well management is controlling the amount of inventory available. So how effective is a company selling its inventory? That's what this tells us. We take cost of goods sold from the income statement divided by average inventory. As I mentioned, the word average in accounting, we take the beginning balance plus the ending balance divided by 2 to find the average. Another one is called days sales and inventory. This tells us how many days it takes to sell the inventory. Pretty straightforward, right? We take our ending inventory balance from our balance sheet divided by our cost of goods sold from our income statement times 365 days. How many days it takes. Yeah, that's good data. That's just an example of it. Costco versus Walmart. So that's the general basics of valuation of inventory. I'm going to go through just a little bit more through the appendice here. And a lot of this we've already discussed, but it's important to understand the relationship between the balance sheet, which represents the inventory, and the cost of goods sold on the income statement. Remember, it remains on our balance sheet until we sell it. When we sell the inventory, we take it off of our balance sheet, and it goes onto our income statement as cost of goods sold. And you remember how to do that. We talked about making the journal entries when we sell something. Remember, there's 2 parts of that journal entry, right? There's actually 2 entries that happen. The first is we recognize the sale. We debit cash or accounts receivable and credit cost of goods sold. And then we debit costs. So the first part of the transaction is we debit cash or accounts receivable and debit sales. And the second one is we debit cost of goods sold and credit inventory. Okay. In that second transaction, that's where this inventory effect takes place. In looking at the process through the periodic inventory system, it's pretty similar, but it's just ever so slightly different. Remember, the periodic inventory system are for the companies that periodically take inventory. This would be very common for a company like a car dealership because they don't sell a whole lot of inventory every day. They could do a physical count. But you'll see it works very similar to process to the perpetual system. The difference here is that we wait to update. So if we look at the same data set that we had from our earlier example, and we apply the periodic inventory system, we can see that all we're doing here is we're taking all of our purchases, adding them up, and we're taking all of our sales and adding them up, and we're getting our ending inventory. And that's for the specific identification. We follow the same type of process for first in, first out. Got all of our purchases, adding them up, cost of goods sold, adding them up, and then getting our ending balances. And the same for last in, first out. The difference, of course, is that the ending inventory between first in, first out and last in, first out for the periodic inventory system. And weighted average is probably, of course, going to be the easiest one when it comes to the periodic system. All you're doing here is you're taking all of your purchases and dividing by the number of units to get the average cost per unit. Yeah, very, very straightforward. Well, that's for, again, what we just went through. This is the periodic inventory system. I want you to focus more for this discussion for this week. I want you to focus on the perpetual inventory system. That's the harder one that we went through earlier. Okay. So, a lot of it has to do with following the physical flow of inventory when we talk about costing. In inventory and retail especially, we do those inventory counts and we figure out what we have available for sale minus our sales, getting ending inventory for retail. That flows down. Okay, so my point is that you can estimate what your inventory balances are going to be based off of these steps. But don't worry too much about it. I just want to let you know what it was. And that, my friends, is the end of our discussion today on inventory and cost of goods sold. Any questions about inventory or cost of goods sold that I can help to answer for you? I know it's a lot to take in, it's a lot to digest. Yeah. Hopefully you took decent notes. It's really not all that difficult. It's just a matter of understanding the 4 different methods, right? And that's really what it boils down to. So if you go through that exercise again, or if you go through, I think there's like 2 decent examples the book has. If you work through those, those will also help you to understand it. But I'm very confident you'll do well on this quiz. I'm very confident in that. Just take your time with it, work through the examples. You'll totally get this. For those of you who work in retail or have worked in retail, you'll probably appreciate this a little bit more because when you go into the store, you kind of get an understanding. It's like, oh, they're probably using last in, first out. Well, here's why they're using it. So you just kind of applying that to life and understand that. And and Tanika brought up the restaurant industry, and probably using first in, first out. Yeah, definitely, because of the perishable goods, just like the grocery store, right? So think about the business as if maybe it's a business you work for. Think about the business you work for, or maybe you have worked for them or whatever, and think about what they probably used, right? It's just a cool way to think about business in a general sense when you apply it that way. Any questions, comments, concerns about inventory, cost of goods sold, or anything about this course, this class in general? Doing okay for you, hopefully.
No, this was good. This lesson was straightforward.
Good.
Yes, thank you.
Yeah, good. I'm glad that it's straightforward. Yeah, that's what I like to hear. Awesome. So, just as a reminder, what we have to do for this week, we have our hypothesis on inventory evaluation. Remember to complete your hypothesis and respond to two of your classmates. And then the other one is the quiz related to what we just learned about with inventory and cost of goods sold. So please accomplish those two things. If you can do it during your class time on Thursday, that would be awesome because it'll, helps you to plan out your week accordingly, right? So thank you all so much for your time today. I really do appreciate all of you being here. If you ever need anything, you can email me, call me, or set up office hours. I'm still here for you. I plan to be here all the way through November. My trip got postponed. Delayed until November 5, so I will be here in the United States at least until November 5. And then I'll be in Colombia for 3 weeks, and then I'll come back. So you got me for a little while longer. But thank you all so much again. I appreciate all of you. Have a wonderful rest of your night. Take care. Bye-bye.
Thank you, Dr. B. You too.
Thank you.
Thank you for the lecture, Dr. B.
Hey, my pleasure, Daryl. Thank you.